Hi, and welcome to 2022 Home Ownership Day. I want to thank you for taking the time out of your busy schedule to look into what homeownership can do for you and for your family legacy. I'm going to get right into it by introducing our first speaker, who's going to be talking about the 2021-2022 housing market. His name is Logan Matashami. Let me tell you about Logan just a little bit before he comes on. Logan Matashami is a housing data analyst, financial writer, and blogger covering the U.S. economy, specializing in the housing market. Matashami's work is frequently quoted in Bankrate.com and Bloomberg Financial. Logan is also a lead analyst for HousingWire. Montashami has been an invited speaker at the AmeriCatalyst, the California Association of Realtors, and other economic conferences. He's a recurring guest on Bloomberg Financial, where he discusses the health of the housing market. Logan Mohtashami, now retired, has been called a social media star by National Mortgage News and the chart guy and housing guru by nearly everyone else. Mohtashami's astute analysis of the economic data and years of direct lending experience allow him to present a unique, informed, and unbiased perspective on the financial markets. Thanks again for joining us for Homeownership Day today, Logan. Why don't you take it away?
It's great to be here, especially being a local Orange County person. So the state of the U.S. economy, the state of the U.S. housing market, if economics is demographics, then it shouldn't surprise everyone that the U.S. housing market has done well during this period of time, even with COVID, even with the forbearance issues. The United States of America was the first economy to recover because what do we have? We have mother demographics, and the ages 28 to 34 in the United States are the biggest age group ever recorded in history. When you look at first-time homebuyers, median age is 33. Naturally, if you believe in the progression of what humans do all the time, you know, they rent, they date, they mate, they get married 3.5 years after marriage, they have kids, they buy homes. Naturally, years 2020 to 2024 was going to be the best housing period this century. And the best thing about it is there's no credit bubble, right? And I think that's some of the success that we have in 2020 and 2021 was that we were kind of coming from the weakest housing recovery ever from 2008 to 2019. So we entered this period of time without booming sales on leveraged credit. And then COVID happened, and all COVID did really was pause the delaying of home buying for about 6 weeks. If you look at the data after 6 weeks, we had a V-shaped recovery in the purchase application data, and then we had a surge of demand toward the end of 2020, which basically really pushed data very aggressively. And then 2021 was very stable. I know we deal with a lot of people in the housing industry. I call them the housing bubble boys, or then I changed their name to the forbearance crash bros. And none of that happened, actually. I coined the phrase forbearance crash bros because I knew these people were going to be wrong. And we just kind of wanted to highlight one of the travesty cult groups in our history. But we're in 2022 now. So what's happening in 2022? The positive is demographics is the same, right? That's the primary driver of housing. Second is mortgage rates. Mortgage rates still sub 4%. The negative is, and the same thing I talked about on Bloomberg Financial in January of 2021, we have to be concerned about home prices escalating out of control, right, in years 2020 to 2024. Why? Because inventory levels are drawing down. So one of the things I talk about is that if you look at total inventory levels in America, from 2014, they've been slowly moving lower, right? Nothing fast or anything, but they've been slowly moving lower. What else has happened since 2014? Purchase application data has been rising every year, right? So we get to the point of here's years 2020 to 2024. And this is really crucial to my work because I always separate housing from 2008 to 2019 to 2020 to 2024. So here we are. Demand picked up a little bit. It isn't like booming. We don't have a credit boom or anything, but it was big enough to draw inventory levels down, total inventory levels below 1.52 million. That is the downside of housing. So naturally, when the recession happened, very brief, and ended in April, people thought, oh, here we go again, massive foreclosures, massive inventory. No, we start 2022 with inventories at all-time lows. And just to give you some perspective of Southern California, if you actually look at Southern California homes on sale, you take LA, San Diego, Orange County, at the start of the year was less than 7,000 homes. You think about the millions and millions of people living in Southern California, that's all you've got. Now, inventory is very seasonal. It always rises in spring and summer, but falls in the, fades out in the fall and winter. But we're starting at all-time fresh lows with sub 4% mortgage rates and sub 4% unemployment rates. That's the negative, because what it is we have too few homes, too many bidding wars. And the only thing that kind of changes this if demand gets weaker. And, since the summer of 2020, I always talked about it, if you really want kind of a slowdown to create a breather, because this is kind of what we want. We don't want this kind of atmosphere, because you can see what's happening. Price gains are unbelievable. And home price growth here in America actually is very timid compared to other countries. If you look at Canada, New Zealand, France, the UK, Switzerland, their home price rate of growth has been much stronger than ours, because they never had a big decline like we did from 2006 to 2011. So here is the issue. How do we get inventory to increase if demand is stable? Well, we haven't been able to do this, right? Even in 2018, and I like to focus on 2018. Remember, everybody was complaining 2018, 5% mortgage rates, things slowed down, but that was a balanced marketplace, or days on market, it was about 30 to 45 days. People had choices, right? So things might not sell fast, but it was balanced. Here, you don't have balance. So you need higher mortgage rates. The only problem is, I'm a technical bond market guy first. I don't target mortgage rate discussions. I go with where I think the bond market is going. It's really hard to have the 10-year yield get above 1.94%, which means mortgage rates over 4%. This is something I've talked about in 2019, 2020, 2021. It's a big theme of my work. So to get 2022 for things to cool down just a bit, to give breather, to give inventory, we need mortgage rates over 4%. It's been very difficult. I mean, you think about economics in itself, you're taught that if inflation is hot and economic growth is hot, rates have to rise. Hasn't worked, right? The trend is your friend. And if you look at 30-year mortgage rates, if you look at the bond market since 1981, it has been going down in a trend for 4 decades, right? And that overrides anybody's personal economic beliefs. So for me, for us to get over 4% this year, we need the world economies back. We need Germany and Japan's 10-year yields to go up. And then you could get a pausing cool down to get some inventory up. But until that happens, we're stuck. Because in 2018, even with 5% mortgage rates, total inventory in America didn't budge, right? So there's monthly supply can go up and down, but it doesn't. And this is the authentic inventory crisis that not only we face here in Southern California, but around the country. The professional grifting of housing has been done by fanatical people, usually grumpy men, who run around and say, housing is in a bubble, we're going to crash back down to 2012. Well, technically, it's the lost decade, right? It's been 10 years now. So a lot of these people thought that inventory would escalate because homeowners are panic stock traders, like they sell like on a dime. No. Credit is another big part of my work. If you look at American homeowners now, on paper, they have never looked better ever in history. Their mortgage payment versus disposable incomes are at all-time lows. Their household debt payments versus disposable income, all-time lows. Their nested equity versus their debt, all-time highs. And when COVID happened, a lot of bearish people went all in. For myself, for HousingWire, on April 7th, 2020, I wrote the America's Back Recovery Model. It was designed for things to come back in 2020, right? And then the ongoing work was like, hey, listen, forbearance is never going to be this issue. Why? Because these homeowners were all legit. On paper, they look great. Post 2010, best loan profiles you'll ever see. Our family's been in banking since the late 1950s. It has never looked that better. Hence the forbearance crash bros premise that I did in the summer of 2020. This thing will decline on its own. We went from near 5 million forbearance to under 882,000 more people are getting off it. Why? Because people are homeowners. They're not investors, right? Investors is a different subject altogether. People buy their homes, wife and husband have sex, their kids go to school. This is where they live. That's it. Housing is the cost of shelter to your own capacity to own the debt, right? It's not an investment in that mind. People are just buying a payment. So post 1996, and I always like to use 1996, and when mortgage rates made another leg lower down below 8%, Civilian workforce grew. It's really hard in America to get home sales under 4 million, right? It authentically really only happened in one period, 2008, which is the beginning of my slightly weaker demographic patch. So it's just hard to get inventory rising because this story has been here since 2014. Nobody wants to talk about it because it's really boring. Like economics, like there's two things I always talk about. Economics done right should be very boring. It's not really designed to be very exciting, but you always want to be the detective, not the troll. So housing's been infected by troll armies, and you guys all know what I'm talking about. Every day housing's going to crash. I mean, think about how grumpy these people are. For 10 years telling everybody housing's going to crash. And then COVID happened. Oh no, guess what? Homeowners who have a very fixed low debt costs are just going to foreclose their property or whatever just to justify some of the most untalented people in history. No. But there's that negative side, is that people just stay in their homes longer. From 1985 to 2007, housing tenure was 5 years. From 2008 to 2022, it's 10 years in Southern California, and places it's 15, 16 years. I've been in my house for 17 years. So it's very hard to get inventory to rise, and this started in 2014. So I think one thing that we have to see is can mortgage rates get above 4%? If it does it create natural inventory to increase due to softness in demand? In the previous expansion, that has been the case. Whenever rates get over 4%, things just cool down a little bit. It doesn't create a crash, right? You're going to hear this. Mortgage rates at 4% or 4.5% are going to create a crash. It never has. It just cools down, which means the days on market grow. That's for me, that's my main thing, is that housing is extremely unhealthy just because the total inventories are low and the days on market are too low in the teenager age. We want 30 to 45 days. We're not going to get that unless rates rise or demand really weakens. So I think that's the story for 2022, where last year I never even talked about 4% mortgage rates because we can't get the 10-year yield above 2%. But here, maybe if the world economies in Japan and Germany, all bond yields rise together, we might be able to get there. And if that happens, it'll bring a cooling process down. But as of right now, not only did forbearance not create the crash, we are at fresh new all-time lows. For the economy itself, it's really running really hot just because the labor market's really hot. Why? No country has a Dorian Gray labor market. Another big theme of my work. Job openings 10 million. You know, even back in 2020, I used to tweet these things out. Jolts 10 million. People age, they leave the workforce, and then they die. That's pretty much it. Right? So you have to have a natural replacement worker. The United States of America has this really big advantage over a lot of countries, over China, over Japan, over Europe. We have the millennials and we have Gen Z. Both those two together are bigger than the total population of Japan. Those are your replacement workers. Those are your replacement buyers. So there's parts of the US that have a hard time getting labor. Exclude the COVID factor away from the equation. We had 7 million job openings before COVID hit. And now the baby boomers are moving toward their 60s and 70s. They leave the workforce and then we replace them in. That's the benefits of housing in that sense. So I always said years 2020 to 2024, total home sales, new and existing, should be 6.2 million above. If it's below that, then it's a weakness. That means home prices escalated, and they did. Right? I have a 5-year price growth model for this period. I thought if we just have 23% home price growth or under, we should be lucky that that happened. Guess what? In 2 years on a national basis, we've already broken that. So there's a positive side of the housing market, and then there's the negative side of the housing market, because this isn't like a credit boom. A lot of my work, a lot of the charts I show on HousingWire and on Twitter and social media, I show people what it looked like from 2002 to 2005. That was a credit leverage boom. All speculative bubbles or all overheating prices usually come from credit or leverage. We have none of that here, right? So we're not actually working from very elevated levels of sales, not only here in California or Southern California, but nationally as well. And then here comes the biggest housing demographic patch ever recorded in history. So you look at it as move up buyers, move down buyers, cash buyers, investors, and millennials and Gen Z. So you can see why the housing bears whiffed, not only like whiffed this small, they whiffed in the biggest fashion ever. Why? Because they don't believe in reading, right? Mother economics is demographics. Demographics and productivity is economics. Housing economics is really driven by demographics and productivity. So naturally, you have the best housing demographics ever and the lowest mortgage rates ever. What do you have to worry about? Price escalation. And here, the inventory story we have in America, in Southern California, is that homeowners are really well off, right? There's no credit risk bubble in a sense. There's no option arms that are going to recast. And a big theme of my work in the last 18 months is when I speak at conferences, I tell people this. If you look at credit profiles in America, 2005 housing peaked. 2005, 2006, 2007, and 2008, bankruptcies were increasing, foreclosures were increasing, sales were declining. Then the job loss recession happened. What happened now? We had the longest economic and job expansion ever in history. And then COVID came. COVID was not an economics crisis. It was a health issue. Paused. That's all it did. Think of it like a snowstorm. Paused people just for about 6-7 weeks, came right back in. Why? Because mother demographics win. And delinquencies and foreclosures and everything were declining for an 8-year period. And then after all this, the homeowner looks even better. Why? Because everyone who could refinance, and now they even have a lower fixed debt payment versus their rising wages. And that's what housing is. It's a big theme of my work: fixed low debt cost versus rising wages. And then that itself creates an inventory problem, right? Because people go, hey, I'm well off. My house is fine. Why? Because if you look at homes in America, we've been building bigger and bigger homes for many decades. Since 1975, the median square foot home was 1,500. Then in 2014, it got up to 2,700. Well, what other thing has happened? Our family sizes have decreased, as well. So the home that we produced over the decades, a new, more expensive new home, is basically suited for a family. Now, of course, people move up, move down all the time, but it is an issue that is very difficult because people always go back to the 2008 playbook, right? They think that, well, in a recession, people are going to foreclose for no reason. So a lot of the charts I show, FICO scores, extremely elevated, debt payment ratios, all-time lows, nested equity, really fine. So basically, we're at the point where now people say educated high-income earners who have a very good financial profile are going to sell you their homes at a major discount, not on market bid, but 25 to 30% to justify some of the more tyrannical trolling people in America. No, that's not going to happen. So we have to keep an eye on where rates are because the demographics are staying the same. I have home sales slightly lower sales trends for 2022 than I have for 2021, but demand is stable. And that's the biggest theme of my work in this period is years 2020 to 2024. Don't think of housing as a boom because the boom means the price gains. The price gains are unhealthy, but the demand is stable replacement buyer demand. Each year you got young people, you got people moving up, you got people moving down, then you got cash buyers and investors. That creates a stable period of demand. And for the rest of the year, you're just going to have to see what happens with rates. My concern is rates go lower. We stay in that channel, it goes lower. And here we are again, spring, sub 4% mortgage rates, unemployment rates are low. And then we go back into we can't let inventory grow stage. So I think that's the thing you have to look for the rest of this year. Can mortgage rates get above 4.5%? Now remember, all 4 to 4.5% does, like it does in the previous expansion, just creates more days on the market. That's what I want. All I talk about is I just want days on the market to grow just to give us a breather because you don't want these kind of price gains, right? You don't want this year. And my concern is 5 years of this. So 2 years, 2 for 2, X negative, right? Demand looks perfectly normal to me. But we are in an inventory crisis that was not the case in 2008 to 2019. I know a lot of people said, well, their sales can't grow because there's no homes to buy. There are plenty of homes to buy back then, right? Look at inventory now. Inventory's collapsed to all-time lows in the winter of last year and this year. Home sales have been increasing, right? So there are always homes to buy. Why? Because the seller is a natural buyer, right? A seller doesn't sell their homes to become homeless. They either rent a home or buy another place. So demand is there. It's just that we can't get inventory above a certain level. So my goal on a national basis using the NAR numbers is we want inventory between 1.52 million and 1.93 million. That is very low historically, but it creates a more balanced marketplace, less drama. Less drama is a good thing. So that's what I'm hoping to see. But again, I need rates to go higher. So it's one of these, yeah, it's really positive. We have really low rates. Unemployment rate is low. Demographics are great. But the inventory issue is not helping anything. And we can see even with forbearance, we started 2020 fresh new all-time lows. If you take the NAR data and everybody else, this is where we're at.
So much information, Logan. Goodness. Wow. I think that I agree with you. It would be nice if we had a little more days on the market. I don't know if any of, how many buyers versus sellers that we have in this room right now, but it's a whirlwind.
It is. And, just recently, a friend of mine's, I saw her Instagram post. She had 31 offers on her house.
Yeah.
And it's just, housing is just a home to live in, right? People just want to buy a house. And one of the things that actually, there was a lot of mistakes last year by the housing bureaus, but one of the things they pointed to is that the home buyer sentiment surveys have all collapsed to all-time lows. And then they were like, in 2021, here comes the collapse. Nobody wants to buy a home. That's not what the data is telling you. It's telling you that people want to buy a house, but they're competing against 10, 15, 20, 25 people. It sucks, right? If you're a home buyer, I get it. Because I've seen people, even though I retired from the mortgage industry, I remember people with really good incomes, down payments, getting blown out, not like losing to 2 or 3 people. They're like number 15 or 16. That is the unhealthy side of housing. So the positive, there has to be a negative. The negative is that we've never actually experienced this in the United States of America in recent history. And if you look at around the world, like I like to do world home price charts on Twitter. And when I show Canada, Australia, New Zealand, Swiss, we are so behind all these other countries in terms of the rate of growth of pricing that, Canada laughs at us. You think you guys have a home price issues. We've been doing this for 22 years, right? So the fear should have been to the upside, not to the, home prices are going to go back to 2012 levels, which technically would be like 103% decline in prices in 1 year. No, the housing bubble boys are just professional grifters. That's all they are. So the inventory is the negative issue at this point. The demographic demand is the positive. So you have this really historical battle between can't get inventory higher and really solid replacement buyer demand.
It is. It's such a struggle. Desiree, you had your hand up. Did you have a question for Logan?
Yes, I'd like to make a comment. Great session as always. My comment is that I don't think a home is just a home anymore. I think a home is where you actually, a lot of people are taking the money they were paying for rent or owning a commercial building and putting their businesses into the home. And the second thing is they're looking to where they're putting their parents and adding that to it, or the kids are staying. So I think the singularity of being home ownership has now become multiplier. So to your point of how the prices are going into we'll call it the crash boys or all that good stuff that you say, the idea is that we're willing to spend more money for that home because it can be expansive. So the idea is that whether it's in California with a multi-site. So to question to you is that because we're now using our homes in so many different ways, it's no longer just that house. Do you believe that the supply and the bigger the multi-entity of it is going to continue to cause building issues and supply issues to where we can't keep up with the demand because of the supply chain? So how long do you think, I know I'm going on with this question, how long do you project with all things being said? I mean, we got all these different deliverables that are going on because of, potential war and everything else. Do you think this is going to go on 3 years, 5 years, 2 years?
Well, housing starts really don't help the existing home sales too much because the new home buyer typically is a wealthier, older buyer than an existing home. The only thing in the last 8 years, even before COVID or anything, that created days on market to grow was higher rates. So even before COVID and any of the supply issues, we were having inventory slowly draw down. And not a lot of people notice this, but from 2014, inventory has just been going. So the only way to get to somewhat of a stable label back to 2018, 2019 is a weakness in demand. So, and housing starts itself, from 2008 to 2019, weakest housing starts recovery ever. It's been a big theme of my work just because new home sales had their weakest recovery ever. The problem with the housing starts sector is that it really just needs new home sales to grow, and new home sales has a really hard time accelerating because think about it. What's their main competitor? It's existing homes. We have well over 140 million units now. That is a massive market of cheaper homes out there. And what are the new homes marketed? Expensive new homes with all the bells and whistles. So they're offering a more expensive product versus this massive, massive inventory of cheaper homes. So they go slow and steady. They don't really care about the existing home sales market because the total inventory shortage is a benefit to them. They might not say it in public, but that's their advantage right now. They can peel off a few buyers from that area. But when rates rise, that's the only thing. In fact, the only period in time where total inventory increased was in 2013 to 2014, that first big increase in rates to 4.5%. And still, it didn't even create 6 months of supply on a national basis. So it's just, this is a very difficult problem because people are staying home. And then on top of everything, the work from home model. Like if you ever are going to stay in your house even more, if you make your home the gym, if you make your home the office now, boy, you're really pouring in money into your home to stay in there for a long time. Especially if you move from another place to buy something, you're locked in because that's where you want to live. We've designed a society, look at how many TV shows we have on how to make your house better, right? How to spend on your house, how to do this. So we just stay in our homes longer and longer. We don't turn over homes as much. And it's caught up to us at this stage because mortgage rates are near all-time lows right when we have the best demographic patch ever. So yeah, this issue has been here for a while now. It just really accelerated once inventory got below 1.52 million.
So you're not answering my question to the exact point. You're avoiding it. You're going around the circle.
You need higher rates. You need higher rates. There's
so in your best estimate, you've said why 3 years, 5 years, 7 years, put you on the dime.
You need higher rates. I just don't think higher rates are, I actually don't believe rates can get to like 5% anytime soon. So there's no, even 5% mortgage rates didn't correct it. What we could do, we can't get inventory levels back above to 2014 levels, but we can get total inventory back to 1.52 to 1.93. That's still historically low, but it just creates more days on the market. I've always been suspect of mortgage rates getting above 4% in 2020 and 2021. 2022, we can, but it needs the global economies. And what do we need the global economies to do? We need COVID and everything to kind of be away. Outside of that, there's no real reason for rates to really escalate higher. It's been in a downtrend since 1981, and there's nothing that's going to break that. In fact, the 10-year yield today has to be over 270 for it to break that downtrend. It's never done it for 4 decades because the world's populations are slowing down. The economies really can't create inflation. If we don't have COVID here, you don't have inflationary pressures around the world. So it's just, we can be here for a very, very long time on low rates. So weakness in demand, not really a 2022 story in terms of velocity, but rates can create balance. It's never created inventory to skyrocket. You would need like a job loss, recession, and higher rates together. And typically what happens in a recession is bond yields go down and rates go down. So the question is, do we ever get above the 2014 levels? It's going to take a lot of weakness in demand. Now, after 2024, this massive demographics, this once in a lifetime push goes away. So we just go back to normal kind of demand trends. That's why I've always focused on this 5-year period. This is just a once in a lifetime period in the US where we have an extra push from the millennials because that group is the biggest group in history. After that, demographics gets us back to kind of a normal trend. The Gen Z is massive, but it's not as big as this group right here, just in this 5-year period. And now they're coming in to buy, but again, they buy like everything else a little bit later in life. So it's just hard to break out of this funk when you have so many people in just a very unique period.
Yeah, it's like overcrowded, right? Yeah. Not enough inventory.
And I think one of the other things is that there's a lot of people who keep on saying, well, population growth is slowing, right? That's true. It's been true for years. I'm sure some of you heard, remember the silver tsunami, the grifting marketing tactic that all baby boomers were all going to sell their homes to millennials who can't afford them and home prices will crash 70%. That was supposed to happen in 2015. You have to be careful. There are professional grifters who love grifting on housing and they have been wrong. Hence I call it the lost decade, right? Economics, demographics, the biggest demographic, like to me, like, how do you miss this? Like if this was the 1500s and you had to dispatch horses to get information and 2 years later, You get a piece of parchment that tells you, oh, here comes the army invading you. No, you have the internet. It's census data. It was always there. It's just that people don't like to read the census data. So it's just for us geeky nerds.
Scary headlines sell, right, Logan?
Yeah,
So
scary headlines sell too.
Question for Logan.
Okay, Saeed, we got to get to the next session soon. Though, so
Is
let's
there
make
any
it
study
quick.
on the mindset of the buyers that are willing to pay $100,000 over the asking price? Any study anywhere? How do you justify that?
It's insane. It's just shelter. It's
Yeah.
people need somewhere to buy. People just need a home to live in, and they have money, so they're not going to lose. And I think that's it. That's why I always say housing is the cost of shelter, and people are going to do whatever they can to get the bid because they're planning on staying in that home for a very long time.
Logan, I cannot thank you enough. You always give us such amazing information, and it's really a joy to follow you on Instagram. For those of you who are not already connected to Logan, be sure to click on the links in the description below and connect with him. Follow him on Instagram. He's got some really great information. Again, Logan, we thank you for taking your time today and for joining us and just telling us about your expertise at Homeownership Day. I also want to take a moment to thank all of our sponsors this year for Homeownership Day 2022. These are the people behind the scenes that are helping to spend dollars to get our website edited, the people who are helping to do the marketing campaigns and reaching out to the outlets so that you hear about this event and that the word gets out about Homeownership Day. So we want to thank the Money, Real Estate, and More podcast, M&M. You guys don't forget to subscribe to their podcast and to their website. They actually have a directory on there if you need any professionals to do business with or just consult with. They've got a really good directory on the More and More Network. So thank you again, More and More Network, for being one of our sponsors this year. I also want to thank NAWRB, Women in the Housing and Real Estate Ecosystem. They are a huge supporter of Homeownership Day. They've been a part of this event since we were meeting at Chapman University years and years ago, and they continue to educate and teach us about different ways and aspects to look at real estate when it comes from the all-encompassing lens of the housing ecosystem. So thank you, Desiree and NAWRB, for being a sponsor this year. I also want to thank Vow to Save. Vow to Save is a crowdfunding platform where people can, in essence, get a website that connects to their PayPal and work with their friends to crowdfund that down payment quicker. So if you know anybody anxious about getting a home, make sure that you tell them about Vow to Save. And our last sponsor is Mountain West Financial. Thank you so much. This bank is not just any bank. They are advocates for homeownership, which is why there's such a perfect alignment with Homeownership Day. They have all kinds of different loan programs, creative loan programs, and their goal is to get you into homeownership. So thank you, Mountain West. We appreciate you being a part of Homeownership Day 2022, and we hope to have you back again next year. Everyone, thank you again for your time. Thank you, sponsors. Thank you, speakers. Thank you, attendees. It's been a great day, and we hope that you make every day Homeownership Day.